What if your vacation home, the beach house, mountain cabin, or family retreat where generations gather could quietly become one of the biggest tax problems in your estate? In 2026, many families are discovering exactly that when proper planning is overlooked. One of the most powerful yet often misunderstood estate planning tools available is the Qualified Personal Residence Trust, or QPRT. A QPRT allows you to transfer ownership of your primary residence or one vacation home into an irrevocable trust at a reduced taxable value while retaining the right to live in the property for a specified number of years. When structured correctly, the IRS treats this as a discounted gift, allowing future appreciation of the property to be removed from your taxable estate. This can be especially valuable given that the federal estate tax exemption in 2026 is approximately $15 million per person, or about $30 million for married couples under current law. Estates exceeding those thresholds may face federal estate taxes of up to 40%, making a QPRT a potentially effective strategy for families with high-value real estate. However, there is an important trade-off. A QPRT is irrevocable, meaning that once the property is transferred into the trust, it cannot easily be taken back. You retain the right to live in the home during the trust term, but once that term expires, ownership passes to the beneficiaries. The strategy works as intended only if you outlive the trust term. If you pass away before the term ends, the property is generally brought back into your taxable estate, largely eliminating the intended tax benefits. Another consideration involves the property's tax basis. If the QPRT succeeds, beneficiaries typically receive the property with your original basis rather than a step-up in basis at death. This may result in higher capital gains taxes if they later decide to sell the property. In North Carolina, where there is no state estate tax, federal estate tax planning remains a significant concern for families with valuable real estate holdings. Owners of coastal homes in the Outer Banks, mountain properties near Asheville, and other highly appreciated vacation homes often use QPRTs to reduce future estate tax exposure. This helps in preserving those properties for future generations. However, QPRTs are not appropriate for every situation. They are generally less effective for properties used heavily as rentals, and they require strict compliance with IRS rules governing personal residence use. Mortgage considerations can also create complications as ongoing mortgage payments may trigger additional gift tax concerns. If the property is sold during the trust term, the proceeds must be handled carefully under IRS regulations to preserve the trust's intended benefits. Because of these complexities, families often compare QPRTs with other estate planning strategies. A revocable living trust can help avoid probate, but does not reduce estate taxes. Joint ownership with rights of survivorship may simplify transfers at death but provides limited tax planning. In North Carolina, transfer on death deeds are not authorized for real estate, making trust-based planning particularly important for those seeking long-term asset protection. One additional factor in 2026 is the IRS Section 7520 interest rate, which can significantly affect the effectiveness of a QPRT. Higher rates generally increase the valuation discount applied to the gift, potentially making the strategy more favorable. Even so, technical calculations are only part of the equation. The most important considerations remain timing, health, life expectancy, and family objectives. A QPRT is not simply a tax-saving tool, it is a strategy focused on control, wealth preservation, and family legacy. It can help ensure that a cherished vacation home remains in the family, rather than becoming part of a forced estate settlement or tax-driven sale. Ultimately, the question is not whether your vacation home has value. The question is whether it has been strategically protected before that value becomes a tax event. In 2026, the difference often comes down to planning. Your vacation home should create lasting family memories, not a potential 40% tax problem for the next generation.